Mike Clements, you hold Swatch as one of the major stocks in your funds, which you manage for Syz Asset Management under a contrarian angle. Now, Swatch has had a very good run in the past 1.5 years. Does it still meet your requirements?
Yes, Swatch still meets the requirements. What we look for in our companies is we look for high quality businesses that can generate good returns in a way that is sustainable. And if you look at Swatch, it has very strong brands and is able to generate large amounts of free cash flow. Now, we bought this stock when it was highly out of favor because of what was going on in the Chinese market. There was an aggressive slowdown where people were assuming that was a structural slowdown versus a cyclical slowdown. We disagreed. We put it into the portfolio. And of course, since then, it's worked very well. And if you look at the related results coming out of Swatch and indeed out of the luxury goods companies in general, certainly the contrarian angle has played out very well with demand roaring back. So we're still very happy with the stock. The improvement in the fundamentals being matched by the improvement in the share price, but we still think there's some upside from the current levels.
Swatch has been driven by export figures from Switzerland to especially Asia. You mentioned China. Don't you think there might be too many expectations now?
So expectations in China are growing. I mean, China is a very important market for Swatch. It's about 25%, mainland China is about 25% of Swatch's sales. So a very strong position for the company. Now, the Chinese growth has been driven by the growth of the middle class, and we still think that's going to continue. Now, some of the expectations that you mentioned are starting to be priced into the company, for sure, but we still think there's a good long-term growth potential there.
Another of your Swiss stocks is duty-free, the duty-free company. There, the share price has gone back a little in the past 12 months, so that would be an ideal situation for a contrarian.
I agree, because we look at these kind of companies in a very long-term way. You know, we have a 5-year investment horizon. If you look at the market dynamics for a company like duty-free, it's ideally placed to play the growing middle class and the increased air travel that will bring. So duty-free is the market leader. It has 20% market share, built that position over many years, mainly through acquisitions. And yet what the market's worrying about is two things. The market's worrying mostly about the prospect of the balance sheet being quite stretched after these acquisitions. And it's also worrying about the prospect of concession fees, the fees charged by airports to duty-free, increasing. Now, we agree with both those points, but our view is that actually the debt is controllable, the cash flow is strong, and actually you get very good, strong long-term growth, which translates into very high cash flow and very high returns.
So the share is better than its reputation?
Well, yeah, we would agree with that. I'm not sure what the reputation is in Switzerland, but for our point of view, this is a very high quality player. If you look at the manufacturers, you know, the luxury goods manufacturers, the people who are making goods which you sell in duty-free shops, they want to access duty-free stores because of the long-term growth potential.
Now, in Switzerland or in Europe, do you look for other opportunities?
Within Switzerland, we like the Swiss market a lot, but the problem with the Swiss market is because you have such good quality companies in Switzerland that normally the valuations are quite high. And for a valuation sensitive investor like us, that can be problematic. Outside of Switzerland, we found some interesting ideas. So for example, we did a lot of work recently on renewable energy, which is of course a growing structural trend. And we invested in a company called Vestas Wind System, a Danish company, which is the world leader in manufacturing of wind turbines.
Market volatility has been high this year, higher than last year, especially in February. We've seen the whole turmoil surrounding the stock markets. Is that a good environment for you? Do you like this?
Yes, market volatility is great for a stock picker because that allows us to add some value. In fact, if you went back to 2017, one of the things that we looked for when we're looking for contrarian ideas was this idea to be long volatility at a time when everyone was short volatility. And so we went into the end of the year in our portfolios with about 11 or 12% of our portfolios invested in companies which benefit from increased volatility. So when in February the volatility spiked and the VIX went from record low levels of about 10, it spiked intraday to about 60 and now is trading around 15. You know, we made a lot of money in the portfolio and our volatility plays protected us from the turmoil on the market. And going forward, you know, as a long-term investor, this increased volatility allows us to identify new ideas and take advantage of some of the mispricings we see in the market.